Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Want to know the worst financial advice ever given to savers? Well, if you have a 401k, 403b, IRA, or thrift savings plan, this one piece of bad advice might just surprise you.
Welcome to the only show in the country dedicated to helping savers worry less about money, the WorryFree Retirement, with your host, retirement specialist and six-time author and fiduciary, Tony Walker.
Over these past 41 years in personally working in the financial trenches and in visiting in person with more than 20,000 savers, I must say that one of the worst pieces of financial advice ever perpetrated by the financial world on old Joe Lunchbox came about in the year of our Lord 1978, when Congress passed into law something called the 401k plan. As discussed in William Wellman's classic, The Great 401k Hoax, sure, the new plan of saving for retirement sounded great, on the surface at least, but the sales pitch to Joe Lunchbox did go something like this. What we're going to do is do away with those guaranteed lifetime pensions offered by Joe's employer and replace it with a risky, non-guaranteed savings plan where old Joe could deduct his contributions from his paycheck going into this 401k plan, and here's the key word, postpone the taxes owed on it until he retired. Back then, before the dangers of putting money in a pre-tax account could be exposed, all of this sounded good as over time, trillions, that's trillions with a T, trillions of dollars left the pockets of Joe Lunchbox and millions of other savers and went directly into the pockets of Wall Street, while at the same time having no idea how much in taxes one day Joe Lunchbox would owe. Now, as you're about to learn on today's show, the advice coming from Wall Street to max out that 401k by putting as much in as one could has proved to be some of the worst pieces of advice known to man. Why? Well, I'm glad you asked. Well, welcome folks to the Worry-Free Retirement, and yes, I am that little man in the sweater vest, 401k tax planning specialist and the world's friendliest financial fiduciary, Tony Walker. And before we share with you why for most savers, maxing out their 401k has been the worst piece of advice known to mankind, let me introduce two young lads in the Worry-Free Production Studios who are always giving me good advice on how to maximize this show each week. America's favorite financial sidekick, Mr. Aaron Orander, along with Louisville, Kentucky's most laid-back graphics artist, Mr. Derek Hudson. Okay, see if you've ever heard this sales pitch. Mr. and Mrs. Smith, what if I could show you a way to save money for retirement by putting off any taxes owed on your contributions to it? A plan that will save you on taxes because you won't have to pay them now, but can pay them when you will retire, of course, assuming you'll be in a lower tax bracket. If I could offer such a plan, how much would you invest in it? Well, if you and I are honest with ourselves after hearing of such a great way to save on taxes and save for our retirement, I'm sure our answer would be, I would do the max, which, since the creation of the 401k in 1978, is how most savers have saved for retirement, by maxing out their life savings into these 401k plans. Problem is, since 401k plans, 403bs, TSPs, lump sum pensions, and IRAs are what is referred to as qualified pre-tax plans, from a standpoint, you have no idea how much in the way of taxes and lost opportunity cost you will have to deal with in the future. In other words, while the 401k might be considered a wonderful way to save for retirement, which it is, as you're about to learn, it is one of the worst investments when it comes to planning for retirement. So if you are at that saver who has at least $250,000 or more in pre-tax retirement accounts and you are retired or nearing retirement, you have something we call the tax tumor. The real question is, for you personally, is just how big is it? Well, stay tuned as we share with you how we at Tony Walker Financial can reduce your tax tumor and possibly the rippling effects that will come along with the cost of money as you go to take money out of it. So stay tuned. Good stuff coming your way. This is the Worry-Free Retirement, and I will be right back.
This Tony Walker Financial 5-star review comes to us from Jennifer. Always so helpful and knowledgeable. They treat you like family. When I lost my husband, they were so careful with my money and helped me by explaining all my options. During such a terrible time in my life, they gave me the support I so desperately needed when it was difficult to even be able to think clearly. If you'd like to read more of our 5-star reviews, simply log on to TonyWalkerFinancial.com.
Have you recently retired, been laid off, or offered a buyout? Has the company you work for moved, been acquired, or closed its doors forever? And finally, do you have a 401k with a previous employer you'd like to move to safer territory? Then take advantage of this opportunity to move your 401k or lump sum pension to Tony Walker Financial. Let's meet in person to discuss your retirement options. Log on now to TonyWalkerFinancial.com to schedule your free, no obligation appointment. Let us help you today. Several weeks ago, with my lovely wife's permission, I shared with you this CT scan of something my wife did not know she had, nor could anyone else detect, that buried inside her body, just under her sternum, was a huge mass, or what some might refer to as a tumor. Surprisingly, Susan's tumor caused Susan no pain, as the specialist we consulted with estimated that this tumor had been buried inside her body for years, but slowly grew to a point where it began to cut off her airway and, of course, affected her oxygen levels. In other words, if this grapefruit-sized tumor had gone unchecked, well, you get the picture.
Heavy.
Imagine that something the size of a grapefruit went undetected to the naked eye, but nevertheless, it was there, gradually growing to a point that it was doing severe damage to Susan's thyroid. And such are the ways of tumors growing inside our bodies that we may not even know exist, which is the same problem with the tax tumor growing inside any pre-tax retirement account, whether it be a 401k, 403b, 457, TSP, IRA, or listen, even a lump sum pension that is yet to be taxed. The question is, how big is your tax tumor? Well, just like relying on a surgeon to find out, you too will need to meet with a trained retirement planning specialist to find out first how much you will one day owe Uncle Sam for all those years you put off paying taxes, and then secondly, and most surprisingly to many savers in retirement, the rippling effects that your tax tumor will create in the way of higher costs elsewhere. In other words, not only will your tax tumor grow alongside the growth of your account, but the rippling effects might even be worse than the taxes themselves. So what I thought we would do, we're going to take a look at some of the rippling effects that I see on a daily basis. And again, this is especially for those who have at least $250,000 or more in pre-tax monies. Now, why am I focusing on these larger amount of accounts? Well, quite frankly, some of you contact us and you might have $60,000, $70,000 in a 401k IRA, which is fine, but generally you're not going to have any tax issues with that. That's because in the tax world, the more you make or the more you have, the more the government's going to try to take. So this information I'm sharing with you is really geared towards those of you, again, who have $250,000 or more in pre-tax retirement accounts. So let's kind of take a look at some of the strategies Tony Walker can help with. But first, what are the issues at hand? The first thing we'll talk about, and actually I'm going to go over this in a whiteboard segment following this particular segment. It's really interesting, but it's the taxation of Social Security. Now, as you're going to see in the next segment, in many cases, Social Security is not even taxed. That's right. Depending on other income, potentially you would pay zero taxes on your Social Security. And as we're going to see in a minute, the big beautiful bill, while it helps some people, a lot of people, because of the pre-tax tax tumor that has to eventually hit your tax return, is going to cause problems on your Social Security and actually increase taxes on it. So that's a huge rippling effect. Another rippling effect of yanking money out of these tax-infested plans is increase in Medicare premiums, something known as IRMA. In fact, Aaron, put this up full screen. I want you to look at this. Notice, again, we're back to the same theme. The more you make, the more they take. Now, the way they're going to take more money from you in this case is if you make more and more money, your Medicare Part B premiums go up, and they can go up significantly. And this is a huge issue for people who have large 401ks or IRAs. And what they end up doing, we'll talk about this in a minute, is they put off the pain and they act like the tumor's not going to grow and the problems are going to go away, which it actually gets worse if you do nothing. Next, tax bracket creep. Again, let's put this up full screen, Aaron. My gosh, folks, you don't understand something. There's two problems. Number one, we don't know what these taxes are going to go to in the future. Right now, most of them are very, very low, comparatively speaking. But even if you start out in a lower bracket, let's say you're in the 12% bracket, when you start taking out large distributions from a pre-tax account, every bit of it is taxable. It goes on your tax return, and it can cause what I call tax bracket creep. In other words, that money can throw you into higher brackets, and we can show you strategies to try to keep you from creeping into these high tax brackets. Next, this is a huge issue. With over 3,500 clients, many of our clients are retired. We have a lot of people pass away, quite frankly. We had 67 death claims we had to take care of in 2025. So what happens is, here's how this kind of plays out. Our clients have large and significant IRAs, okay? They pass away. In many cases, I meet their adult children for the first time. That's right. Generally, they come in to meet with me or one of the other fiduciaries. We help explain what their parents had, and if their IRAs, we have to share the bad news with them. Guess what the bad news is? The tax tumor didn't die with their parents. The tax tumor gets passed off to them. And with the new laws, unfortunately, the government is forcing these adult children to take out that money within a 10-year period of time following their parents' death. What's the problem with that? Well, let's say somebody out there is still working, making good income. They'll look at me sometimes and go, Tony, I don't need this money nor want it. The problem is they have to take it. So, moral of the story, folks, when you die, unlike the tumors that we might have in our bodies die with us, this tax tumor does not. It gets passed to your kids. So my thoughts are, why wouldn't you want to address it now? Let us help set up a strategy to try to minimize these taxes to your children upon your death. Finally, now this is a hard one to explain to people. Years ago, I studied what's called lost opportunity cost. Most advisors, even the financial world, really doesn't understand opportunity cost. Opportunity cost means when you put off getting something now, there's actually a cost. And I'm going to create another another whiteboard to go over this. In fact, I might even talk about it in the radio show. This is really interesting. What we're taught to do is save for the future, which we should. The problem is with the passage of time, with all the fees you're going to have to pay those 401k managers to manage your 401k, with the loss of use of the money. In other words, if you're socking money away and maxing out a 401k, you may not have any money left over, so maybe you have to go out and borrow money to buy a house. Well, that's interest that's on the loan that you could have had you not invested in the 401k. Now, again, we're not telling you not to do the 401k. I'm just saying, folks, with the passage of time, when you put money away somewhere and you have no access to it or use, you're generally creating other costs somewhere, which is called lost opportunity cost. So there's a lot of rippling effects that go into this. And my concern is that many of you, because there's so many people out there offering, quote, retirement planning services, many of you are rushing into financial decisions. And what's happening is these so-called financial experts are leading with financial products. That's not how you do retirement planning, folks. The first thing you have to do is come up with a plan, a game plan. You should not rush out and buy any financial products without that game plan. And an advisor is not going to give you a written game plan laying out exactly how this is going to play out. I would certainly get a second opinion. Put up full screen, Aaron, our game plan. This is what our game plan looks like, folks. It's a proprietary software. Nobody has anything like this, and this is available possibly to those who qualify. Again, what I would suggest doing if you're looking for a game plan and a second opinion, it's absolutely free. You'll be talking to me, Tony Walker, the owner of the company. Why don't you do this right now? Log on to TonyWalkerFinancial.com. You're going to click on that Let's Get Started button. We're going to arrange a free phone call with me, and if I think we can help, we're then going to meet in person to lay out this free retirement game plan. Do that, please, before you buy any products. I can tell you, we have a lot of people come to us and they have regret not having a game plan, and a lot of them get stuck in products, or they're stuck with high fees, or they have no clue what the heck's going on. You don't want to do that in retirement planning, folks. You got one shot to get this right. So give us an opportunity to talk at TonyWalkerFinancial.com or call us anytime at 877-499-9255. Well, when I return, I'm going to share with you somebody who wanted to do something called a Roth conversion. They went from paying zero taxes on their Social Security and found out that when they tried to do this big Roth conversion, that the big, beautiful bill that was supposed to save them taxes didn't save them a penny. This is the Worry-Free Retirement. I'm Tony Walker. We'll be right back.
Are you retired or retiring soon? Do you have a 401k, IRA, 403b, thrift savings account, or lump sum pension that you'd like to move to safer territory? Did you know that all the money you see on your 401k statement isn't really yours? Depending on your overall taxable income, the government has essentially a lien on your 401k that can tax as much as 40% of your money when you go to take it out. Tony Walker calls this the 401k Tax Tumor. For over 40 years, retirement specialist Tony Walker has helped thousands of savers worry less about money by creating game plans to deal with your tax tumor. Get control of your retirement by controlling the taxes owed on it. Schedule a free meeting to see if you can reduce your tax tumor and provide a guaranteed income you can never outlive. To get started, simply log on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com.
You know, one of the things as we record this show in September of 25 is this idea of the big, beautiful bill, or whatever it was called, and this notion that Social Security taxes were going to be eliminated or significantly decreased. Now, like with any passage of any bill, first of all, let me say this. Let's put this graph up, Aaron. This is a graph we show all the time that deals with tax brackets, but notice the headline. The more you make, the more they take. Folks, almost all tax laws have what's called phase-outs. In other words, the more money you take, even as we're going to see with this big, beautiful bill and the Social Security so-called tax savings, the more likely you are to not benefit from these savings. Again, the more you make, the more they take. And you're getting ready to see this is what happened with this big, beautiful bill. So let's kind of look at the basics of Social Security. First of all, let's imagine that a husband and wife, he has $36,000 a year in Social Security. Maybe that was his full retirement benefit. His wife took half of his in this example. And let's say they had no other income. That was it. The question is, will there be any taxes? The answer is no. Now, again, this gets very complicated. We have 2 tax certified people on staff. We answer all these questions for our clients. But in general, in this extreme example, if all they had was Social Security income, there would be no taxes. In fact, they wouldn't even really need to file a tax return. But what happens in the real world, especially for all of you out there with those tax-infested 401ks and IRAs that have yet to be taxed? Remember all those tax savings those things were supposed to give you? How does this have a rippling effect on things like Social Security taxes? Well, now we got to go to a complicated rule called the provisional income. Put this up, Aaron. There's another goofy tax deal. Now, the provisional tax income is dealing with Social Security taxes. And notice what portion of taxes could be taxed on Social Security. Either 0% of it, 50% of it, or 85% of it. Now what's interesting, while they index Social Security for inflation, these provisional incomes have not been indexed for inflation for many years, meaning actually more people are falling into the higher tax brackets of Social Security. I know this gets confusing, folks. I didn't write the laws. I'm just trying to do my best to explain them. But here's the real world. Okay, first of all, let's go over these new big, beautiful bills. First of all, the maximum deduction it's adding to the standard deduction is $6,000 per person. That's all. So let's say you're married filing jointly. The standard deduction is $33,000. That means you will add $12,000 of a deduction. Not bad, but only if you make under $175,000, because then it gets phased out. For joint filers over $175,000, this thing gets to be nothing. And then if you're single, it's only $75,000. So a lot of people will not be eligible for this deduction. And here's the other problem. Again, let's say you've got $1 million 401k or IRA and you haven't needed the money and you're just letting the thing compound. You keep forgetting it's taxed. Not only is it going to be taxed, not only if you pull out a bunch, the more you make, the more they take, et cetera, et cetera. It also could tax your Social Security. This came up the other day. Gentleman came in. I'm just changing the names to protect the innocent. He had $1 million IRA. He had watched a YouTube video to convert, okay, to a Roth, okay. Watch these YouTube videos, folks. I don't know who all these people are. Anybody can start a YouTube channel. We've been doing this. I've been in this business 41 years. I have over 20,000 people I've met. We have over 3,500 clients. Most of them are retired. This is what we do day in and day out. But the problem was this $200,000, not only was it going to be fully taxable, and not only do you get IRMA and all this other stuff it was going to affect on his Medicare premiums, but basically now every bit up to 85%, put this provisional bracket back up, Aaron, 85% of this Social Security that was tax-free now has to go on his tax return. And of course, with that amount of money, he's not going to get any of this big, beautiful bill deduction. It's just going to be the standard $33,000 standard deduction. So folks, if this sounds confusing, if you're sitting there in the dark about this stuff, we need to talk. We understand retirement. We understand tax planning. So if you'd like a free second opinion on your situation in retirement, log on right now to TonyWalkerFinancial.com. Click on that Let's Get Started. Let's arrange a free phone call to see if we can help. And if we can, we're going to be meeting in person to discuss your personal situation. TonyWalkerFinancial.com, or call us anytime at 877-499-9255. We'll be right back. Our client spotlight today shines brightly on Mr. Greg Ray. Greg, good afternoon, and thanks for joining us today.
Nice to be here, Tony. Thanks for having me.
You're so welcome. So what prompted you to contact us at this time? Because you've only been a client, about a year or so. So what prompted you to contact us?
I just happened on Sunday morning to see the Tony Walker Show, quite frankly, Tony. And we bought your book, Live Well, Die Broke, and your story and your principles and your Christian foundation and the balance of, what do you need to have? What do you want to leave to your kids or what have you? Because I got a couple of boys and their families, and then the rest of it, how you want to live your life while you still can live your life, that is. So we stopped in for a visit. We simply came in and asked for a visit, and we got to sit down with you, and that was about a year and a half ago, and we're so glad we did. So.
And again, not to disparage anybody, but going from a large bank to I'd say we're more of a boutique firm, locally owned and everything, service-wise and everything, what have you experienced maybe that's a little different?
The biggest thing is, and probably the most surprising thing is, the presentation of the suite of products that you had. If we wanted to stay in the stock market and play the stock market game, which is a little bit more risky, you had the Charles Schwab product suite, fine and dandy. We could continue doing what we've been doing basically through the bank. The fixed income annuity package, some of the things that you had in long-term care planning, the tax planning, the retirement planning, and making a plan and working the plan, and the responsiveness of all of your staff is just incredible.
Well, we appreciate your business and hopefully many more years to come. So thank you, Greg, for doing business with Tony Walker Financial.
And Tony, best to you. We appreciate all you've done for us.
You're welcome.
Looking for an advisor you can trust? Schedule your free phone call with Tony at TonyWalkerFinancial.com or call 1-877-499-9255.
Having worked in the retirement planning field for 40 years, I know it's not just about how much money you've saved for retirement, but making sure you one day don't run out of money. That's where mailbox money comes in.
Mailbox money!
A reliable, lifelong income, much like the pension plans from the past. If you're interested in turning your 401k into mailbox money, let's talk. Just set up your free 10-minute phone call with myself at TonyWalkerFinancial.com. That's TonyWalkerFinancial.com.
Welcome back to the WorryFree Retirement with the money missionary himself, Tony Walker.
In John chapter 5, there's an interesting scene that plays out as a paralytic man who for the past 30 years has been patiently waiting for someone to assist him in getting into the healing waters at Jerusalem. In verse 6, we see this poor man's plight, where Jesus comes along and asks a simple question. Do you want to get well? Now in verse 7, we must assume that he does want to get well because he tells Jesus that he would get into the water if others would quit jumping in line ahead of him. Knowing no one is going to help this man until he helps himself, Jesus replies this way, "Then get up, pick up your mat, and walk." In the book of Acts, chapter 3, verses 6 through 8, we see a similar instance where this time Peter, after seeing a lame individual in need of help, says this to the man in need of this assistance, "Silver or gold I do not have, but what I have to give you in the name of Jesus Christ of Nazareth, get up and walk." Next comes the response from the lame man. He takes Peter's hand, and at once the man is made strong. He then springs up to his feet and begins to walk and goes about the temple of courts, praising God. And such is the way of life when faced with adversity and the realization that the world is not offering any help. And while we help lots of savers get a handle on how to deal with the tax tumors buried inside their 401k plans, I can't say they necessarily jump for joy and praise us for it. But I can attest to the fact that many of our clients do tell their friends and coworkers about the work we do in reducing their tax tumor. So what is the Bible teaching us about this notion of feeling lame or stagnant in our adversity with nothing we feel we can do about it? Well, the late great theologian Charles Spurgeon says this about those who wait for others to help them in their time of need. He says, "They wait in vain and watch for nothing." My thoughts, I believe that faith in God's ability to heal us also relies on us picking up our mat and walking with our own 2 feet. In other words, you are not going to get anywhere if you just sit there and do nothing, hoping someone else is going to come along to help. The world, unfortunately, is crueler than that. In fact, sometimes the world thinks they are helping us by helping us, rather than telling us, as Jesus and Peter did, to pull ourselves up our bootstraps and get moving, to ditch that security blanket that is holding us back and instead lean on the grace and knowledge of our Lord Jesus Christ, and that's right, get going. And yes, this taking action to improve our lives also includes dealing with the inevitable taxes you and I are going to owe and your family's going to owe on all of those tax-infested pre-tax 401k and IRA plans. So if that's you, maybe you're that person who has more than $250,000 of savings that has yet to be taxed, and you're ignoring the fact that you have a tax tumor. My question is, do you want to get well? Do you want to meet with someone experienced in dealing with tax tumors? A local retirement planning firm with 20 full-time employees, 2 of whom are certified in the art of tax planning. Then do this. Get up out of that lazy boy, grab your phone or computer right now and log on to TonyWalkerFinancial.com. Take advantage of something we call the free 10-minute fiduciary phone call. Hey, internet not your thing? No big deal. We've got operators standing by 24/7. You can call us toll-free to set up that free phone call with you and I. Just call 877-499-9255. Well, that's all the time we have for today's show. But you remember, between now and next week, if all else fails, you be worry-free and you make it a good one.